Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. This video is going to be focused on the stock market, and we're going to be talking about the broader and longer term macro picture on US equities. And I wanted to start off this video with this chart here of the global equity valuations. And you can see the US stock market here. The black line is just dwarfing every other stock market index in the world, whether that's developed markets or emerging markets, with PE ratios that are around 3 times more elevated. This is something we've been talking about throughout the past few weeks. US stocks are very close to dot-com bubble valuations, and there's just a general feeling of euphoria in the market, right? With the number of startups privately valued at more than $1 billion in 2021, it tripled from 2020, clearly showing that there's excess in the system over the past couple of years, excess liquidity leading to abnormal type of market behavior, right? I wouldn't say this is healthy market behavior. And that combined with the fact that there's still a lot of leverage in the system, right? You take a look at the derivatives, the total amount of derivatives in the system were at levels that we've just never seen in stock market history, with 700 trillion US dollars in derivatives. And when you look at these types of charts, the equities versus commodities ratio, it makes you wonder whether we're about to see some big changes in the market environment and whether or not investors should perhaps be starting to look to protect their capital from drawdowns in the market, similar to the 1970s period, right? Big drawdowns in the stock market throughout this period, and of course the dot-com and 2008 period. So we're going to discuss that in this video. We're going to discuss what indicators we can regularly take a look at to tell us if that kind of event, that kind of market environment switch is something we should be expecting in the very near future, right? If you've been watching our videos throughout the past few months, especially throughout the entire year of 2021, and you've been on our website at gameoftrades.net, you'll know we personally have a very risk-on portfolio, but we're very aware of the imbalances that we have in the system, the excesses that we have in the financial markets. So we want to be fully prepared for when that big switch does eventually come. If you're interested in following these crazy markets with us, make sure to click on that subscribe button. If you enjoy the video, make sure to click on the like button. And now, without further ado, let's get right into it. All right, the first indicator I want to take a look at is the high yield index option adjusted spread. Now, it gives you a ratio of the performance of high yield bonds relative to better quality bonds, right? And so when you're about to see a major downturn, when you're having tighter liquidity conditions, tighter monetary conditions, that type of environment increases the odds of seeing bankruptcies. And so this is why we take a look at this ratio, because this is the market's interpretation of that. When they start to expect increased bankruptcies, they start to bid up the price of better quality bonds, and they flow out of high yield, what you also call junk bonds. And so it's pretty fascinating on this chart here. For example, leading up to the 2001 recession, you had widening spreads. So investors were pricing in those tighter monetary conditions and increased probability of defaults in the market. And the same thing happened in 2007, right before the great financial crisis. So this is one of the indicators that you can look at to tell you, oh, yep, there's a problem here. We should be watching out for some type of black swan event, some type of recession. You're not going to get a Lehman collapse when bond spreads are extremely low. You get a Lehman collapse when you've got bond spreads already pricing in part of that macro environment that's favorable to an increased chance of bankruptcies. Now, if you take a look at where we are here in 2022, we have not seen bond spreads widening. So the market is not pricing in tighter monetary conditions. It's actually pricing in very easy monetary conditions for now. By the way, if you're so far enjoying this video, don't hesitate to click on that like button. There really is hours of research and preparation that goes into making these videos, making sure they're well put together, making sure they're understandable, educational, and actually useful for you guys. And that's all for the price of a couple of seconds to hit that like button. It is really appreciated. And of course, subscribe to the channel if you haven't already. Now I want to move on to point number 2 here, and that is taking a look at the 2-year government bond yield. Now, over the past few weeks, we've discussed this concept of the bond market controlling the monetary environment. When you see bond yields rise, it signals tighter monetary conditions. Credit becomes more expensive, right? It's harder to borrow, and there's more incentive to save. So consumers save rather than spend. And so that creates a slowdown in the economy. And the bond market can tell you where we are in that cycle, right? Are we in very easy monetary conditions? Are financial conditions very loose and with a very low probability of seeing a downturn? Or have yields been rising a lot and there's an increased chance of seeing some type of risk-off market move and likely a recession? In fact, I think we mentioned this in one of the previous videos. The 2-year bond yield is an incredibly accurate indicator of stock market tops, right? Look at this. Big top in the 2-year yield in 2000, followed by a big top in the stock market. Big topping pattern on the 2-year yield in 2007, topping pattern on the US equity markets just a few months later. And here there was COVID, so that does not apply in my opinion. So the longer you see yields continue to rise, the more that means we've had tighter monetary conditions, and the more likely it is that we're going to get some type of risk-off move. That we've just seen yields begin to rise. Typically, it takes multiple years before it really impacts the market. It could be quicker now. The economy is very fragile, and the system always seems to break at lower yields. So if the trend continues, it's reasonable to expect that it could happen in a shorter time frame than we've seen before, but we're not quite there yet. Now, another way of looking at financial conditions on the bond market is by looking at the yield curve, right? That's a very classic indicator of recessions, indicator of market performance, indicator of financial conditions in the economy. Now, this is the 10-year yield minus the 2-year yield, and it systematically predicts recessions in 2006, in 2019, even in 1989. And so the closer the yield curve gets to zero, the closer you're getting to a recession. That's as simple as that. It's one of the most simple indicators out there. And you can see we're heading there right now, right? No, we're not quite there. We're not yet at zero, but we're heading there. Now, one mistake I do see a lot of people making is using the 3-month yield instead of the 2-year yield. And that's not at all something that we're going to be looking at for the next recession, right? Although it was extremely useful in the past. Look at this. In 2000, it predicted it. In 2006, it predicted it. In 2019 as well. But I think it's going to be very different this time. Why is it different? If you watched our video on the 1937 crash, you'll know that the current monetary environment, the current macro environment in 2020, 21, and 22 is incredibly similar to the 1930s, where you had QE, you had the federal fund rate stuck at zero following 1929, and you had debt to GDP absolutely skyrocket, right? So an incredibly similar macro environment to the 1930s. That's absolutely undeniable. And you can see throughout the 30s here, I've got the yield curve of the 10-year minus the 3-month yield. It was an extremely poor predictor of recessions throughout that period. You never got a inverted yield curve despite many recessions throughout this period. And that's because the Fed controls the short end of the curve, right? They can hold the 3-month rate at zero a lot better than they can hold the 2-year yield at zero. And so when they're doing that, when they're doing debt monetization, the short end of the curve, particularly the 3-month yield, becomes a poor predictor of recession. So I think that's one of the mistakes that investors are going to be making in the next recession, is looking at the wrong yield curve that has been an incredibly accurate predictor between 1960 and now. But if you look back at the specific period that was similar to what's going on from a macro standpoint now in the 2020s, it was an absolutely useless indicator, right? So do not make that mistake. So once these signals go off, once the bond spreads begin to rise, the 2-year yields begins to top out, and the yield curve begins to tell you that we're inverted, that we're about to get a recession, how do you protect yourself? That's a large part of our focus at gameoftrades.net. We take a look at a variety of asset classes, of sectors, right? We take a look at the investment case for precious metals, cryptocurrencies, global stock market, global equities, global bonds, commodities, right? The energy sector, all of these are going to be fantastic trades. And depending on the timing of all of it, some of them can provide massive protection against big drawdowns in the market and lets you buy cheap stocks, cheap equities after having benefited from massive upside potential on some of these trades. And I'm going to show you an example, right? You take a look at gold throughout this period. Stocks are overvalued in 1971. You buy some gold. And as the stock market is consolidating, you've got gold rise significantly, letting you appreciate your capital to buy those stocks at the same or cheaper price. And you had the same phenomenon back in 2000. Stocks were overvalued. You buy some gold, waiting for cheaper prices, and you enter back in 2009 having massively appreciated your capital. So we're going to be working through that every step of the way on gameoftrades.net with our global macro strategy, taking a look at every opportunity that we have on the financial markets. If you're interested in following our research and our convictions, make sure to click on the link down below to test out the free trial. We're really extremely excited about what's coming up throughout the next few years in terms of the trading and investment environment. I hope you are too. Now, that's about all I wanted to cover in this episode. I hope you guys enjoyed. Don't forget to click on the like button and subscribe if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.